If someone claims that wealthy people have financial tricks up their sleeve that the rest may not, you would probably find this easy to believe, right? Well, that's not really accurate. Now sure, having Scrooge McDuck money gives you ready access to higher level financial tools, but the truth is that just about anyone can use them as well, as long as they have the needed knowledge and have at least some assets to work with. In other words, you don't necessarily have to be wealthy, you just need to know what you're doing. And so it goes with borrowing money. Most people go to a bank to finance their home, car, or education because, let's face it, that is the easiest and most familiar approach, especially when you don't have many tangible assets. If you do have assets such as a home, you can borrow against it, and this is commonly called tapping your equity, with the loans referred to as HELOCs, or home equity lines of credit. But with a HELOC, you are putting your home up as collateral, and that's not something you may be comfortable with. What if there's another way, especially if you've done some investing and have a portfolio? Well, surprise, surprise, there is another way. What I'm referring to here is an SBLOC, which stands for Security-Backed Line of Credit. It's pretty much what it sounds like. You're borrowing money against your stock portfolio, and it's one of the main ways that high net worth individuals get their hands on cash. Guess what though? SBLOCs are freely available to anyone with knowledge of how they work and a stock portfolio to borrow against. And it doesn't need to be a large portfolio either. While a bigger one will certainly allow you to borrow more money, using an SBLOC is not tied to any specific amount and is open to anyone who owns stock. Let's take a few minutes to describe all the details and see if this is something you could also consider doing if you need some capital to start up a business or pay off a high interest debt. Hey, if you're new to the channel, my name is Elliot. I'm a long-time investor and financial advisor. I create helpful videos just like this one to make you smarter about your money. So be sure to like and hit the subscribe button to stay on top of all the new releases. And now, let's get back to the video. Okay, so from the short introduction I went through a minute ago, you probably understand the basic concept of an SBLOC. They are very straightforward, and you are literally just borrowing money with your investing portfolio as collateral. The portfolio can be any combination of stocks, bonds, mutual funds, ETFs, and other marketable securities, and you can borrow anywhere up to 95% of your portfolio. But why go this route? What are the advantages? There are a few, and it's why folks that know prefer this approach. The first is that you are not selling any securities to get access to cash, merely putting them up for collateral. That means you can continue to invest and reap benefits such as dividends and appreciation. You also may avoid potential capital gains, as again, you aren't selling anything. SBLOCs are also very flexible. They are lines of credit after all, and you can get all the benefits without putting your home at risk the way a HELOC would do. If you are unable to repay all or a part of your loan, you risk losing some stock, which is generally better than potentially losing your home. SBLOCs also tend to have lower interest rates than other credit products, and you only pay interest on the money you actually draw upon. Finally, they also come with less fees and expenses than other types of loans. Now, if this all sounds good, there are some downsides as well. By far, the biggest risk has to do with market volatility. We know that markets are constantly shifting, which can cause the collateral backing the line of credit to be volatile. In plain English, your portfolio may go down in value after you've taken out the SBLOC loan. If a downturn causes the value of the securities in your account to drop significantly, those assets may no longer support the outstanding obligations. In other words, the SBLOC loan and assets such as cash or securities will need to be deposited as additional collateral. Failure to do so may result in pledged assets being immediately liquidated without further notice to you and possibly resulting in tax consequences. So yeah, there's that. Now there are of course ways to mitigate this. If you have a large and well-diversified portfolio, chances are it won't dip all that much in a downturn and the lender won't be making any margin calls on your account. It also helps to not actually use the maximum allowed. In this way, an SBLOC is quite similar to a HELOC. No lender will lend you nearly the entire value of your home, nor should you borrow that much from your line of credit, even if they do. Keeping the percentages reasonable, such as 25%, will ensure that you have plenty of padding in case of a stock market downturn, so while you could borrow up to 95% of your portfolio, realistically, no one does this as is just too much risk. An SBLOC lender will of course evaluate you and your portfolio and determine exactly what is reasonable and prudent given your net worth and assets. So what can you use SBLOC money for? Well, I already mentioned reasons such as investing in a business or paying off high interest debt, but there are many others. others. SBLOCs can be useful for quick access to funds such as a bridge loan or for access to capital in advance of receiving a large sum such as an insurance payment, inheritance, lawsuit payout, or bonus. SBLOCs are also used for smoothing out income in cases where it is high but irregular, such as with business owners or bonus-based executive compensation. They're also used in high-stakes deals where financing is needed quickly, including business and real estate deals. As I mentioned earlier, an SBLOC is a favorite tool to quickly raise cash by high net worth individuals whose wealth is tied to securities. However, as I also mentioned, this approach can be used by anyone with a portfolio as long as they meet the lender's minimum. Obviously, you won't qualify if you hold just a handful of Tesla shares, but many regular folks do have sizable portfolios after years of investing, and they can turn to an SBLOC for short to medium term cash needs, and it's a well-known wealth management tool that is very flexible and inexpensive to use if used wisely. And if you never heard of this, now you have. Think this may be an option for you? Talk to your financial advisor and see if it really is. They can advise you and also set you up with an SBLOC lender if you decide to move forward with this type of loan. Okay, hope you enjoyed this video and got a lot of value out of it. If you did, drop a like and be sure to subscribe to the channel. And I will see you all in the next video.